Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action here. We have about an hour to go in the trading day, and traders seem to be betting on the fact that President Biden and congressional leaders are going to be able to reach a deal on the debt ceiling. You're looking at the Dow now up 355 points, the S&P up about 1%, as well as the Nasdaq. And we take a look at some of the leadership that we are seeing today. Consumer discretionary, one of the outperformers on the heels of a slew of earnings reports that we got from the retail sector earlier this morning. Also, regional banks are among the outperformers today. We got a deposit update from Western Alliance. That's helping a bit with investor sentiment today. So again, gains across the board for the three major averages. We're really also seeing some outperformance in energy, industrials, and communication services, Akiko.
Yeah, the big sector we're watching today, though, Shauna, is, of course, retail with earnings in focus there. Target reporting this morning, while the stock is up and results beat expectations, the retail is setting a bit of a cautious tone on the consumer. Target says shoppers spent their money on groceries and necessities instead of clothing and home goods. And Shauna, the words that stood out to me in that call that Target had was affordable joy. We heard them say that over and over, and that sort of sets the sentiment for the consumer right now, at least what we've heard from Target, saying that, look, consumers are spending, but they're not putting out the money in terms of discretionary spending in other areas. Beauty, a big one. Food and beverages, another one. But they are delaying purchases on apparel, home, and other areas. Certainly kind of similar to what we heard from the likes of Home Depot yesterday, who said, look, consumers are starting to delay some of their plans, and that points to more caution, especially in the face of inflation.
Yeah, certainly. And I don't think this is largely a surprise here. I think many of us expected this going into these reports, going into these earnings calls, when we're hearing a little bit more just about the trends that we are seeing from the consumer. But you're exactly right. A softening consumer has kind of been the theme so far this week from the larger retailers, and we're seeing that across the board. You mentioned some of the bigger players there. Also, TJX was out with its results earlier today. They are forecasting a downbeat second quarter in regards to the fact that people are pulling back on their discretionary spending, sticky inflation, forcing consumers to really have to rethink their purchases. And when it comes to the street's reaction to this, Wells Fargo was out with a note earlier today on Target's results, saying that the weakening discretionary demand, just as consumable inflation ends, paints a very tough comp picture ahead. So I think a lot of people are trying to figure out what exactly the next couple of quarters are going to look like. And when you take into account, I guess, who is positioned best of all, we're going to get a reading from Walmart tomorrow before the bell, and a largely expected out there on the street, Akiko, is that they might be able to do okay given the fact that they have such a large presence with their grocery business.
Yeah, because that's what we're hearing that consumers are spending on. Another name that, Shauna, I think you might have mentioned here, TJX is an interesting one for me. They also reported today the company raised guidance, but it wasn't as much as the street was expecting. And this is an interesting one to me because, you know, you sort of think that where consumers are right now in the face of higher costs, sort of the discount brands tend to do a little better. We're seeing that stock of about 0.7%. Some interesting notes coming out also from analysts who cover TJX saying in addition to that market share they think TJX can potentially gain in the face of a cautious consumer, they're also looking at how TJX could benefit from the likes of Bed Bath & Beyond closing down some of their stores. That's an inroad. That's a market that maybe they will be able to capture even further. But that was an interesting one to me because we're sort of looking at Target, sort of groceries, everyday goods, and then, of course, the discretionary spending. But with the likes of TJX, it is about consumers who are saying, well, maybe I can save my money by going for discount prices.
Yeah, Kiko, I'm happy you brought up the Bed Bath & Beyond aspect of that because that also jumped out to me. It was mentioned in the earnings call in regards to the opportunity there to really gain market share, and it was also reiterated from some of the analysts out there in the street. Bernstein's Anisha Sherman, she's actually going to be joining the show later this week, but she was out with a note saying that they are going to benefit, TJX is going to benefit from the shift in market share, especially towards the end of the year around the holiday shopping time. She's saying given the overlap and similarity in their store base and their customer base, locations and assortment, she thinks home goods, that part of TJX is really going to be a big winner there. All right, well, let's talk a little bit more about these retail earnings and the state of the consumer. For that, we want to bring in Kevin Mon. He's Henny & Walsh Chief Investment Officer. It's great to see you here, Kevin. So I guess your big takeaway from the results that we're getting so far, the fact that we are seeing consumers pull back with their discretionary spending, what that signals for what lies ahead.
Yeah, what stood out to me, it was the forward-looking guidance that both Walmart and Target provided, striking a very cautious tone about their outlook for consumer spending in the second, third, and fourth quarter. If the consumer does in fact start to curtail their spending, not only will it affect the earnings of retailers, but also the economy as a whole, remembering that 70% of GDP growth comes from consumer spending. However, there is a silver lining though. If in fact the economy continues to slow due to a slowdown in earnings, the Fed's going to have to stop. I believe they hiked in May and will go away. And in all likelihood, by the end of this year, we'll start talking about cutting rates. And if in fact they're cutting rates during an economic slowdown, which could be a recessionary period, well, that creates opportunities for investors.
Yeah, and Kevin, we'll get to more of your thoughts on the Fed in just a bit. But going back to where retailers are right now, I do wonder that what you make of the street's reaction today. I mean, Target certainly giving a more cautious outlook. We are still seeing that stock up. I mean, is it at the end of the day about some of these big box names that are still able to offer sort of a diversified experience as opposed to some other retailers that are a lot more focused and could get hit further from a cautious consumer?
Yeah, absolutely. You have to look at those retailers that don't have as much of their revenue derived from discretionary items, much more in the staples items, the grocery items that you alluded to earlier. We also have to remember that during periods of economic slowdowns leading up to and through recessions, consumer staple stocks generally fare well. Walmart is an excellent example of a consumer staple based upon their large majority of the revenue that does come from staples related items such as groceries. So we would anticipate consumer staples companies, less so consumer discretionary, faring well, just as we would anticipate healthcare companies faring well during periods of economic slowdowns leading up to and through recessions. And those two sectors, Akiko, they also tend to fare pretty well during periods of interest rate cuts as well. So if you're looking to position your portfolio to take advantage of an upcoming interest rate declining cycle, in addition to an economic slowdown, look to your consumer staples, look to healthcare, and even look to technology companies with strong balance sheets.
Kevin, when it comes to some of the opportunities out there, we have really been stuck in this pretty tight trading range, and
Yes.
a lot of that has to do with the uncertainty that lies ahead. Earnings clearly has not been the catalyst to get us out of that range.
Nope.
What will be?
I believe once we have confirmation that we've reached the end of this rate hike cycle, which I believe I already heard, apparently some on Wall Street don't believe they've already heard, with the 25% probability of still yet another rate hike in June, I believe that provides the catalyst to start looking for opportunities. And where do you look? Look for some of those names that were really beaten up in 2022 that should rebound and benefit the most from an end to this rate hike cycle. Earnings, we've had the second consecutive quarters now of negative earnings growth. Even according to the Fed's own projections, they believe the economy is only going to grow by 0.4% this year. Everything that they wanted to do with this massive and aggressive rate hiking campaign is now coming to fruition. The economy is slowing. Inflation is slowing, but still remaining well above their target. Now we're going to get to see all the damage that all those rate hikes have actually inflicted on the economy.
So, Kevin, a potential pause that you're looking at. I also heard you say positioning yourself for an interest rate declining cycle.
Yes.
I mean, is that what you anticipate, at least in the near-term future?
Not in the near-term future. In fact, at the beginning of this year, I suggested that in all likelihood they were going to raise rates by 75 basis points during their first three meetings of 2023. Fortunately, I got that one right. At that point in time, once they hit that terminal rate of around 5 to 5.25%, I believe that they were going to stop, sit back, and reflect upon all the damage that they've done to the economy. And in all likelihood, wouldn't consider starting to cut rates until early 2024. That may have to take place at the end of 2023 at this point, depending upon how much the economy does slow and how much the consumer starts to rein in spending. Of course, on the other side, if inflation stays rampant or actually goes in the opposite direction and doesn't continue to moderate, well, the Fed may need to step back in. I do not believe that they will. I don't believe they're going to cut anytime soon. But by the end of this year, I believe that in all likelihood, they're going to start considering rate cuts.
Kevin, what about when it comes to rate hikes versus the pause here? The other side of the argument would be that a lot of the economic data has remained extremely strong, even what we've gotten out so far this week when it comes to housing, when it comes to yesterday's retail sales number, that coming in better than expected. Do you think that though, is going to give the Fed a little bit of pause just in terms of the headway that they have made on inflation?
The Fed has been driven 100% to curtail inflation since March of last year, essentially telling investors that they were going to continue to raise rates, cut the size of their balance sheet until something broke. Well, now something has broken. Certainly in the regional banking system, we've seen it impact the housing market, and now it's trickling through to earnings. So what's really holding up this particular economy right now is the strength of the labor market. But now we're starting to see some dents in the armor of the consumer. Just yesterday, we learned that we've hit an all-time record in terms of consumer debt, $17 trillion. Consumers are now dipping more into their personal savings, putting more in their credit cards to help keep up with these inflated prices. How much longer can that last?
So let's talk about some of the opportunities that you see in the market.
Yes.
Two names that stand out to me, both big pharma. What do you see there?
Well, historically, based upon the research we've done at Smart Trust, the three sectors that perform best during periods of economic slowdowns accompanied by declining interest rates are healthcare, number one, consumer staples, and information technology. But there's two ways to play healthcare, right? One is through your traditional large cap pharmaceutical companies that are generally more defensive in nature. One name that we hold and happen to like is Merck. Pays an attractive dividend of over 2%, forward-looking PE of just 17, and continues to be innovative in terms of the types of healthcare treatments they provide. Another way to play the healthcare sector is through smaller cap biotech companies. From an M&A perspective, one name that we hold at Smart Trust is Rocket Pharmaceuticals, so about a $1.4 billion smaller cap biotech company that's using genetic therapies such as gene editing, gene splicing to cure rare and chronic diseases, really at the cutting edge of healthcare innovation in our country right now. That's a little bit more growth oriented. Obviously, the larger cap pharmaceuticals are a little bit more defensive oriented, but the combination of those two should fare well over the next 2 years.
Kevin, you mentioned M&A there, and the FTC blocking Amgen's deal to buy Horizon Therapeutics. How do you look at a move like that as an investor, given the fact that the Biden administration has been very critical of M&A activity and what exactly that would mean here for competition?
It reminds me you have to be a lot more targeted in identifying potential M&A opportunities in the biotech space. They seem to be focusing on these larger names, 30 billion and plus type of acquisitions. I just mentioned Rocket Pharmaceuticals, about a $1.4 billion smaller cap biotech company. I believe you need to look for those smaller cap names that will stay out of the regulatory crosshairs and also have at least one drug in FDA level 2 or FDA level 3 approval status, because that's where the acquisition appeal comes in. And if in fact they have a revolutionary and innovative healthcare treatment, whether it's CRISPR, CAR-T, antibody treatments, these gene editing and gene splicing type of technologies, well, large cap pharma is going to look to use their excess cash on their balance sheet to acquire those companies.
So Kevin, let's go in the opposite direction. You gave us your three picks. What are sectors that you think investors should be a little more cautious on, stay away from right now?
Well, obviously, very volatile sector always is energy. A large part of that, obviously, is driven by mandates coming out of Washington and also supply-demand characteristics that are somewhat outside of our control with respect to OPEC. Other areas to be very leery of as we head into an economic slowdown, which will all likelihood enter a recessionary period as well, is high yield. Any areas where you have companies with high debt on their balance sheet. You want companies with strong balance sheets, a history of growing their earnings, dividend paying, and also an entrenched and committed management team on the stock side. On the bond side, look at investment grade municipal bonds or municipal bond closed-end funds. We think there's a lot of upside potential based upon the difficult year they had last year and also the supply-demand imbalances that exist for municipal bonds today.
Great advice right there. Kevin Munn, we got to leave it there. Thanks so much for hopping on and joining us here in Set. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, an upgrade to Wynn Resorts has casino stocks on the rise today. We roll the dice and dive in to that latest call. Plus, a debt ceiling drama persists as President Biden aims for a deal by the end of the weekend. And Tesla's 2023 shareholder meeting delivering some big promises. We will discuss that later in the hour. We'll be right back. Shares of Wynn Resorts on the rise today, up nearly 6.5% after the team at Barclays upgraded the stock to overweight, making the case that this, quote, isn't the end of Macau's momentum. Joining us now, we want to bring Yahoo Finance's Josh Schaefer. And Josh, when you take a look at the reaction in the stock today, clearly the street very excited about what they heard from Barclays. Why are they so bullish?
Yeah, Shauna, so it's all about that Macau resurgence. And this is something that we heard from Wynn going back to their earnings call a couple weeks ago, basically saying that Macau is coming back at a faster pace than they had expected, and now at a faster pace than Wall Street had expected. So when you take a look at what that Macau segment has done for Wynn, they've reported $600 million in operating revenue in the first quarter. That's the most they've had in Macau since the fourth quarter of 2019. Now, Barclays coming out today and essentially saying they think that Wynn is headed for adjusted EBITDA in comparison to 2019 at a quicker pace than initially anticipated. So they think they're going to get to about 80% of what they were at in 2019 by the end of this year. And then you can see on the chart on your screen, they think they can get to 100% of what they were doing in 2019 by 2024, so into next year. And Akiko, when we think about casinos as a whole, of course, this is a massive story because Macau used to be more than half of Wynn's overall revenue. And it is obviously a big player for something like Las Vegas Sands as well. It's a huge space or region for casinos.
Well, yeah, and certainly with China reopening, that's the activity picking up in a big way. How is this affecting other casinos?
Yeah, so Las Vegas Sands, you saw take a big jump today as well. I think it was up about 3% at one point. Up about 3% right now. And really that's also because Las Vegas Sands is actually the biggest player over Macau. They have the most market share. So it's Las Vegas Sands, then Wynn, then MGM Resorts. And what's been interesting to see in commentary, and Barclays was pointing this out today as well, is travel still isn't all the way back to Macau. So they've started to see more travel from inside China, but those surrounding countries, if you take a look at visitation from surrounding countries, it actually has not picked up really anywhere close to the levels it was in 2019. So there's still a lot more visitation to come. And so essentially the argument here from the street is you can get out ahead of this because it's not really priced into the stock yet. And those revenues are going to keep going up and keep coming back. And that's obviously bullish overall for the space.
Josh, what about the outlook here for Las Vegas? Because you and I have talked a number of times over the last several months that Las Vegas, the numbers of travelers that they are seeing day in and day out, the rates that they are charging for the hotels are at record levels.
And Wynn is winning that battle, which I think is fascinating too. There was a chart in that note pointing out that Wynn is actually getting the most per table, the most per slot, the most per room of anyone right now in Vegas. And Barclays came out and said that they think that that's going to be sticky. They think that Vegas travel overall is going to stay resilient, and they think Wynn is the winner in that space. Now, of course, when we talk overall slowdown, the question is, does that continue, right? Do people keep traveling to Vegas over the course of the year? Right now, we haven't seen any indicators that that won't keep happening.
Yeah, and you wonder if that's going to pick up going into the summer. We keep hearing domestic travel staying closer to home. Vegas, kind of the perfect opportunity. Although I don't think I want to stay there in that
Not
weather.
a far flight from LA, right, Akiko?
You could even drive there.
It's not a far drive.
Akiko might be telling us about her vacation plans, I think.
You might find me in Vegas in a few months. We'll see. All right, thanks so much for that, Josh. Coming up on the other side, the housing inventory crisis in focus. We're going to break down the latest data on housing starts on the other side of the break. We'll be right back. Well, new housing data is putting the inventory crisis in focus. April housing starts rose a little over 2% after a dip in March, but building permits and completions both saw declines. Joining us for more on the housing market, we've got Robert Dietz, he's National Association of Home Builders chief economist. Robert, good to have you on today. A bit of a good with the bad in this report when you consider, number one, the pace of completions at a 15-month low, offsetting the housing starts that we saw hit a 7-month high. To what extent is this a sign of things to come when you consider credit is tightening and you still have material shortages?
Yeah, it's a reminder of the challenges the market faces. We desperately need new inventory. The level of resale inventory for single family homes right now is less than a 3-month supply. There are actually more realtors in the country than there are single family homes available for sale. Builders are ready to begin to step up production. In fact, we have seen now 5 straight months of increases in the builder sentiment indicator that we publish here at NAHB. That's a good indicator that builders are feeling more confident about the market. That's driven by low levels of inventory. But the availability of credit, building material challenges, and the ongoing labor shortages all represent significant obstacles for construction. So, the only way we're going to solve the inventory crisis is by building more homes, but that challenge continues.
Robert, what does the timeline look like on that, just in terms of how quickly or lack thereof, I guess how long it could be until we see substantial improvement when it comes to inventory?
Frankly, it's going to be a few more years. There's a lot of different estimates of the structural housing deficit that the United States faces. My team believes it's about 1.5 million homes. There are larger estimates out there. Freddie Mac believes it's 4 million homes. But on the single family home building side, we really need to be building a little bit more than 1.1 million single family homes a year in order to meaningfully reduce that housing deficit. Right now, say 2023, we're probably only going to build somewhere between 800 and 900,000 homes. So that's just not going to do it. And that means it's going to be continuing a frustrating environment for prospective first-time homebuyers.
Yeah, those numbers you just put out there, pretty sobering and point to just the dynamic in the market right now and how uneven that is. We have seen a lot of buyers, or at least sellers, or incentives driving sales. To what extent can that keep pace with the demand?
Yeah, I mean, demand definitely weakened at the beginning in March of last year. So builders in particular were using things like mortgage rate buydowns to induce demand in the market. That actually was successful because one of the things that we learned was the sweet spot in the housing market right now appears to be getting long-term mortgage interest rates near or right below 6%. According to Freddie Mac, mortgage interest rates are right at 6.4%. So our expectation is, as we clear the point at which the Federal Reserve has stopped raising interest rates and bond markets begin to anticipate slowing macroeconomic conditions, then mortgage rates will settle in by the end of the year in that 6% range. So the demand is going to come, but the challenge is going to be on the supply side. The resale inventory is not going to hit the market because you have a lot of homeowners sitting on 2% and 3% mortgage rates, and they don't want to sell their home because they don't want to give up that low rate. So you're not going to get help from the resale side. So it's got to come from new construction. And of course, builders continue to face the fact that building material costs are up 35 to 40% from where they were pre-COVID. So there's a lot of obstacles in the way. I think this is something that's going to play out for the remainder of this decade. That's how long it's going to take to reduce that structural housing deficit.
So, Robert, despite all that and all the challenges that lie ahead for home builders, we are seeing their sentiment improve just a bit. But we're right around 50, the break-even level. What are you hearing in terms of the optimism that's out there? What's behind that?
Cautious optimism driven by lack of inventory, which is competition in the new construction space, but ongoing concerns. One that's picking up right now in particular is impacts from some of the challenges faced by regional banks. For most home builders, in order to build a home, they've got to go and acquire land, develop lots, and actually construct that home before they sell it. So that requires access to builder financing. And about 85% of that financing for private home builders comes from community and regional banks. The average rate of a development loan right now is above 10%. So that means a slower lot development pipeline, higher development costs, and ongoing challenges with inventory.
Have we already started to see that pullback when you talk about the direct correlation with the struggles we've seen in regional banks? I mean, you highlight that there's already been a 5% decline in deposits.
Yeah, a little bit. Yeah, the 5% decline in terms of bank deposits is part of that story. I think the prime factor here is just the increase in the prime rate, which of course is a direct consequence of the Federal Reserve increasing interest rates. So yeah, anecdotally in our surveys, builders have said it's gotten more difficult to obtain that kind of financing. And we're particularly seeing that, by the way, in the multifamily space. So our expectation is we're going to see a fairly large slowdown as we head into macro weakness on the apartment development side.
Robert, in terms of what you're seeing on a regional basis, where are the strongest housing markets today?
Yeah, I mean, when you think about the single family home building market, more than 50% of it is in the South. 3 of the top 5 top building markets are in Texas. 3 of the top 10 are in Florida. And there are some pockets of strength outside the South. The mountain states, which did experience a fairly large slowdown in 2022, we expect them to rebound because they've got strong population growth trends. And there's pockets of strength in the Midwest. Examples would include Columbus, Ohio, Indianapolis, places where housing affordability offers a real advantage for home buyers and employers. So, we've seen a lot of challenges in the coastal markets. That's going to continue, and that's due to lack of land availability and higher regulatory costs.
Yeah, the cloud hanging over the sector, of course, has been when are we going to start to see this rate hiking cycle ease? When you look to 2024, are we likely to see the bounce back then in the first part of the year? How do you look at that in the context of the housing market right now?
Yeah, our forecast is like everyone else's. We think the Fed is effectively done, maybe one additional rate hike, but unlikely. So the expectation is that the 30-year fixed rate mortgage will settle in at near that 6% level by the time we get at the start of next year. So, we think single family home building right now is forming a bottom after about 3/4 of significant weakness. We'll start to see the monthly data improve during the second half of this year. And that means 2024 is going to see a year of growth after years of decline in 22 and 2023. And as I said earlier, 2025 through 2030 look like a pretty good runway for home building growth, given that ongoing structural housing deficit.
Yeah, so some light at the end of the tunnel. Robert Dietz, it's good to talk to you today, Chief Economist at the National Association of Home Builders.
Regional bank stocks surging on upbeat deposit news from Western Alliance. Yahoo Finance contributor Remy Blair is on the floor of the New York Stock Exchange with the details. Hey, Remy.
Hi there. Well, heading into the closing bell here at the New York Stock Exchange, the major U.S. stock averages are seeing a strong advance, with the averages up by nearly 1% on the session. And speaking of a strong advance, regional bank stocks saw a strong surge today, and this did come on the heels of some good news regarding deposit growth. We saw Western Alliance pop by over 10% on the session, and this came on signs of some bank deposit stability. According to a regulatory filing for that regional bank, we did see that deposit growth ballooned by $2 billion since the beginning of the second quarter of this year. And that would bring total deposits to approximately $50 billion as of May 12th. And that is also an increase compared to the end of last quarter of this year. Not surprisingly, when you look at the year-to-date chart for this bank, we see plenty of volatility. And we all have to consider that we did see the failure of Silicon Valley Bank as well as Signature Bank at the end of March. Now, following the positive deposit growth news out from Western Alliance, we also saw a boost in shares for PacWest Bancorp. It was up by over 17% today, and it has recovered the $5 level. Keep in mind that earlier this month, we did see shares of PacWest Bancorp fall, and this did come on news that it was exploring a possible sale in early May. On the heels of today's pop for both of those regional banks, we saw other New York Stock Exchange listed regional names such as New York Community Bancorp as well as KeyCorp, Comerica, and Trust Financial gain on the session. Back to you.
All right, Remy Blair, Yahoo Finance contributor there with a check on the markets for the day. Well, coming up, we go around the horn and check in on a few trending tickers and top stories as we count down to the closing bell. We'll be right back.
As we continue to count down to the closing bell, let's take a look at some of the top trending stories of the day. We've got Alexandra Canal and Diane King-Hall here to help us break down some of these big movers. First up, we got to talk about Uber, the company rolling out new features today at its annual product event. And among them, a way for teens to book rides. For the first time, Uber will let younger users between the ages of 13 and 17 years old sign up for their own accounts and ride alone. But it's not totally independent. This is very important here. Their account is going to be linked to a parent or guardian's account. Now, the owner of that adult account will be notified when their teen requests a ride. They'll also be able to monitor the trip in real time. They can even call the driver and speak with the driver during the ride if they need to. Akiko, at first I was a little bit on the fence about this. I think I still am. I'm not totally sold, but they are taking a number of steps here in order to ensure as best they can that this ride is going to be safe. And they are really expanding their ridership pool.
Yeah, I mean, the bottom line is this is Uber trying to ride that momentum at a time when their closest competitor, Lyft, has really had some struggles. Uber has made it clear they want to expand the app. It's not just about ride sharing as we know it. And this is just one additional tentacle. You talked about some safety measures that are in place there. Uber has said that only highly rated, experienced drivers will be able to complete these rides for teens. I still think that this is going to open it up to other safety concerns, but there's one more thing that they announced that I'm curious to get your takes, Shauna and Diane here. They're also going to allow families to request rides with car seats in them.
With a car seat, yes.
LA in New York, they've got a partnership with Nuna.
I saw that.
I think that's a good idea.
It is. It is a good idea because you can't always just, load in the car seat everywhere you're going. So it's helpful to have that, especially when you're traveling, to have that feature. It's something that had been kind of informally a part of the Uber ecosystem previously, but you never knew if you were going to have a driver who had a car seat or not. And so I like that feature. And I like this. I do understand the safety implications. So they're going to have to figure that out with regard to teens. I like this. And especially when you're dealing with even family members, because I've done this for one of my family members who, has health issues. So I'll order an Uber and kind of handle it for her. So I like that feature. Another thing I saw that Uber did is the phone number, right, Allie? Wasn't that cool? They launched a new phone number for family members who just can't, the older family members who can't do the app.
Mm-hmm. My mom still has me follow her ride, so I know exactly where she is at all times.
As you should.
As I should, which is always a good thing. But, I do not have any children, but I was a teenager at one point, and I would have loved this feature, especially during those moments when you're running late to somewhere, you need a ride somewhere. But one thing that I'm curious about is how this will affect ratings, because I saw on TikTok, there's a trick to find your ratings. I have 9 one-star ratings.
9? What do you do?
I don't. Shauna, I'm going to send you this TikTok trick because all my friends were shocked at how many one-star ratings they had over the course of their Uber experience. And this story just made me think of that. So go on TikTok, figure out.
A one-star rating for you as a rider, or you rating the driver 1 star?
As a rider. Now, I am blaming all the trips I ever took with friends or family members.
Maybe they're getting you mixed up.
Maybe they're getting me mixed up by someone else. But I encourage everyone to go check out that TikTok hack because it's pretty wild to see those results.
It's a little hit to the ego, right? I have seen my rating. I haven't checked it lately, but it's not the best. I think I am a good rider, but we can share that in another conversation. All right, let's talk about the story I'm watching here. Bed Bath & Beyond may be going out of business, but that has not stopped retail traders from betting on the company's turnaround. The Wall Street Journal reporting the stock, which now trades, by the way, in the over-the-counter market, remains among the most popular trades for individual investors on platforms like Fidelity. In fact, the Journal reports that last Friday, investors bought more shares of the retailer than that of Meta and Alphabet. It's made up about near 10% of trades on the OTC market, with investors speculating about the company's future and a potential U-turn. Guys, I will remind viewers who are looking at this to say, number one, the company has filed for bankruptcy. Right. They are shutting down more than 300 stores. And by the way, the company has also said investors will likely get wiped out. And yet here we are talking about retail traders betting big.
Yes, Akiko, I'm like, is this a YOLO trade? What is even happening? I looked at it today. It was up. It's like, okay, so it closed at 17 cents a share yesterday, up at like 18 cents a share today. I don't know why people are getting involved with this right now. I mean, Shauna, like, this is crazy.
It doesn't make sense, but it's also, this is something that we've seen before when companies file for Chapter 11 protection. We saw it with Revlon last year. We saw it with Hertz going back to 2020. It does not make sense. I don't think it is a smart move. If you are one of these people that are buying these shares for 17, 16 cents, whatever it is today, you got to be ready to lose all of it, because the company has said that the shareholders are going to be wiped out. And if you're betting on a turnaround strategy from Bed Bath & Beyond, it's going to take a heck of a lot of work given that amount of debt load, what they have in liabilities, over $5 billion when they filed.
Fundamentally, it doesn't make sense. But knowing these meme traders, I'm not surprised by this at all. Even the week that Bloomberg reported that there was a bankruptcy coming, the stock was up over 30% at that point. So this is just one stock that I think meme traders have fallen in love with for whatever reason. This was the start of the meme craze. And I remember when we were a part of that, that was such a crazy story to see unfold. But Bed Bath & Beyond was at the center of that. So I think they're not going to give up on this company anytime soon, even if the fundamentals don't make any sense.
Clearly. I mean, it's getting a lot of chatter on social media as well. I saw chatter on it
always
today.
has been.
I was like, what? Why? I don't understand. I mean,
at the end of the day, it doesn't cost a lot. Let's end it there. If it's 16 cents a share or whatever it is, what do you have to lose?
This is true. One more thing person, I should say, that's getting a lot of chatter, that would be Elon Musk, who slammed work from home in a wide-ranging interview yesterday. He called it, quote, morally, what was the word he used? Morally bankrupt? Was that morally wrong? That's what he called it. Another quote that stood out to me was when he said the, quote, laptop class is living in la la land. His point in part was that service workers, like people who work on cars and your home, have to be in person, so why not just about everyone else? He also said he thinks people are more productive in person. Now, he said that before. We did a Twitter poll today, Yahoo Finance, to see if others agree that it is, quote, morally wrong. Nearly 30% of people agreed with Musk. That surprised me. 45% said it's not morally wrong. And the rest were pretty much agnostic, basically. They said it could be a case-by-case basis.
I personally think, morally wrong. I don't know if I necessarily agree with that. I think there's certain jobs that, you have to be in person for. If you're a doctor, you can't do surgery from home. No. But in other types of situations, you can complete your job from home. I also think that in this environment, at least right now with unemployment low, the hybrid model is sort of here to stay. Yeah. The Wall Street Journal had a piece on how the return to office has stalled overall, and that the majority of workers are going in 2-3 times a week because they have that leverage that they can pull with their employers. And employers are sort of too scared to say, okay, you have to be in the office 5 times a week. They've gotten used to this flexibility.
Were you surprised by that, Akiko?
To pick up on Ali's point, though, I mean, if you look at where things are, things have stalled. Castle, which is, they put out some pretty good data every week on where office occupancy is right now. They've got it at about 49.5%, roughly 50%. And companies are having to make that decision, whether they want to say you've got to return to work even if you lose some employees, or you say the hybrid model works. Now, Elon Musk's point about service workers having to work actually makes sense to me, but if you don't need to come in, if that doesn't knock productivity, what is the case for a return to work? At least you could argue that's why companies are sticking to a hybrid model.
Yeah, I mean, this is no surprise from Elon Musk. He was one of the first out there who was very critical that people were even working from home in the first place. He first gave the ultimatum to Tesla employees that they needed to be back at a minimum of 40 hours in the office per week. And then, of course, when he bought Twitter, he also gave that same ultimatum to employees there. When it comes to what employees want, at least in this environment, given the fact that the labor market remains very tight, employees tend to have the upper hand. So if employees do want to work from home or have that hybrid model and are able to do their jobs at home, it does make it very tough for bosses, for executives to force people to come in on a day-to-day basis if they want to retain some of that top talent. We were mentioning some recent surveys and what we've seen in terms of recent data. There was also one out from Pew Research saying that a third of workers with jobs that can be done remotely are working from home all the time. About 40% do a hybrid situation. So clearly people like flexibility. They like it to some degree. It might not be fair, but if you're able to do your work from home, it's tough to argue against that.
And I will say, if you work from home, it makes it a heck of a lot easier to Netflix and chill. And that is my company that I'm looking at today. After a new note from JP Morgan analyst Doug Amick suggested the company's password sharing crackdown could be at risk amid the ongoing writer strike. Amick suggested Netflix might not like the optics of announcing this crackdown, which is essentially a price increase from the viewpoint of consumers, as production for many of its major shows like Stranger Things and Cobra Kai remain paused amid this strike. The analyst did add that the delay will likely have a ripple effect on the growth of its ad tier, as a password crackdown would have driven more users to sign up for the cheaper option. Now, guys, it's worth noting that Netflix did say the password sharing crackdown will hit the U.S. sometime in the second quarter, so we haven't passed that deadline yet. But you have to wonder how Netflix is approaching this, especially from a revenue and profitability standpoint.
I mean, that was the idea with announcing password sharing crackdown. They're doing it overseas, and it has taken effect in certain countries. It's supposed to take effect in the UK within the next couple of weeks. So they're still moving forward with that plan and maybe still testing the waters with how they've talked to partners across the pond about the potential ripple effect of that and potential consequences from that and the response to that. But they're moving forward with that plan. So I don't know that I understand that the writer's strike is in play here. So that could certainly maybe dial back their plans about when it's going to happen. But I think it's still going to happen.
Well, and you could argue, Ali, I know you've been watching the writer's strike closely. We're now, in week 3 of that? There are no signs of any type of deal being reached. I mean, this is just one thing that Netflix is going to have to worry about if this strike goes on as long as we expect it to, which is to say that writers are saying they're not going to budge right now. And so while we've heard from some of these streaming companies saying the pipeline looks okay for now, I do wonder what other levers these streaming sites are going to have to pull, because the Writers Guild, at least, is making it pretty clear they're really in it for the long haul.
Yeah, exactly. I mean, I think that is the big question right now, just in terms of what this is going to do for potential subscriber growth or lack thereof, because of the fact that so many of their hit shows, or some of their hit shows, I should say, including Stranger Things, Emily in Paris, I think also production shut down as a result of the writer's strike. What exactly this is going to do to Netflix's profitability here, at least in the short term. We already know Netflix has been cutting costs or is looking to cut costs going forward. Initially reported by the Journal last week about $300 million cut that they are looking at over the coming quarters here. So Netflix is in a tough spot. We know that they are relying on the password crackdown in order to boost revenue down the line. If they have to delay it to the third quarter, I think there's going to be a heck of a lot of questions, or people wanting an analyst to ask those questions on the next earnings call.
So I'll do a confession here, since we did a confession earlier. So I do share someone's password, but it was, look, we were in the same household before. It's my ex-husband's password. So I will get one when that time comes.
But are you going to get the full one, or are you going to go with the ad tier? Because that's the other argument.
That's
it could really delay the growth of the ad tier segment.
This is true. It's at least I have time
Diane,
to think about it.
I appreciate the honesty here, but I don't think you have to be shy about that. I mean, I share passwords.
Guilty.
We do it in the family. I mean, there are so many people that do that, which is why Netflix sees this as a huge lever to drive revenue, right?
Yeah, they do. And it makes a heck of a lot of sense. I think a lot of people
would use it.
Are pirating, at least to some degree. Sharing password sharing is the most, I guess, easiest way to say it, and most friendly way. All right, Diane, Ali, thanks so much for hopping on for this.
Well, the next Fed meeting is still a month away, but markets are pricing in a pause. The likely shift in policy as investors looking for new opportunities. And our next guest says stocks will be the place to go, as history shows equities do well in the period between the last rate hike and the following rate hike. Vice Chair from Tom Lydon joins us for this week's ETF report, brought to you by Invesco. Tom, good to talk to you today. You know, we had a guest on earlier who was saying, look, we're already looking ahead, at least in the medium term, potential rate cutting cycle. But as you look across the sector right now, how do you think investors should be positioning themselves?
Well, we're surveying advisors all the time. And just yesterday, we had over 600 advisors tell us how they felt about the next year. It's funny, 2 years ago, their biggest fear was inflation. 2/3 said that was keeping them up at night. Now it's only 16%. Their biggest fear is a recession. But most feel that the recession is going to be kind of a soft landing. And with that in mind, kind of what you pointed out, the period of time between the last rate hike and the first rate cut usually is a good period of time for the markets. But so far this year, we've seen most of the movement in tech stocks. In the S&P, like SPY, has had a pretty good run since the beginning of the year. However, small caps have basically put up a big goose egg. But the big thing to remember here, when you look at SPY, which is the S&P 500, and IWM, which is the Russell 2000 ETF, their PE ratios are quite different. 21 for the S&P 500 and half that, 11 for the Russell 2000. So when you see days like we've seen today, where the Russell 2000 has done twice of what the S&P has done, that might be an indication that it might be smaller and mid-cap stocks days coming ahead.
Tom, what about the bond market, the opportunities within fixed income? What are you hearing from advisors in that space?
Yeah, Shauna, the 60-40 for a lot of advisors and investors was dead, but it's kind of come off of life support and it's back to life. And as you're getting paid for short duration, that's really nice. But if we're going to have lower interest rates a year from now, advisors are pushing out towards longer duration and in the form of intermediate term bonds where you can get a higher yield, but a higher yield for longer. And on top of that, if you pick something like a Vanguard intermediate term corporate ETF VCIT, not only can you get a higher yield, but also you might have appreciation as rates go down over the next year. I mean, it's amazing for us to even talk about it as people have lost so much money in the bond market. The pendulum may have swung, and over the next year, things look a lot more rosy for fixed income.
So what's the breakdown you think that investors should be looking at? We talked about 60-40. Is that still the number, or how should they be allocating if you're looking at fixed income as a potential opportunity, but still keeping your foot in the equity space?
Sure. I think the biggest concern for most investors is after going through a year like we did last year, a bad market for stocks, a bad market for bonds, the worst time that's happened in 40 years, a lot of people put money on the sidelines. What you don't want to do is wait till you feel good about the market again. Get back to that 60-40 allocation. Diversify. Don't just put it all into the S&P 500. Make sure you have some mid-cap, small-cap, and overseas. Overseas stocks are also a great value today. And then as far as fixed income, we're now finally getting paid, and there may be a period of time where bonds actually pay something that's decent for the coming years. So again, I think the water feels better than it did last year. Get back to a long-term allocation. If you got scared last year, don't wait till your stomach tells you that it's okay to go back in.
Tom, how are advisors, how are investors viewing the stress that we're seeing within the banking sector? Because yes, regionals, a number of regionals moving to the upside today, but every couple of days we certainly see that uncertainty creep back in. How much is that clouding investors' judgment at this point?
Well, it's one of the things they are concerned about, Shauna, but we're also concerned about global tension, higher taxes, those types of things. I think for the average investor, they're over the fact of what happened with those banks that had to be bought out or went under. I think they feel that the government, the Fed, and the big banks are working together. There's also good opportunities where many of these regional banks are in pretty good shape, but they got painted with the same brush and their valuations are pretty cheap. So you're going to see more buyouts in those areas. I think the worst is behind us. That's a sector that's always going to be there and probably always going to do well. And most importantly, if we see rates lower a year from now, for those bonds that they've got on their balance sheets, they're going to be priced at better levels.
So is the way to invest in that space through ETFs? I mean, we were seeing it bounce back today, the regional banking ETF, but when we saw sort of the concerns around First Republic as well as PacWest, it was hit pretty significantly.
It was. So KRE is the regional bank ETF. Boy, I tell you, if you've got a cast iron stomach and a little bit of money on the sidelines, look, there may be a little bit more movement to the downside, but that's come down pretty low. Go in, lift up the hood, look at the banks in there. There's some really solid banks, and they all shouldn't be have the baby thrown out with the bathwater as far as regional banks. I think this is something in the coming months we're not going to talk about as much.
We'll see. We'll have to have you back on, Tom. Tom Lydon, VettaFi Vice Chairman. Appreciate your time today.
Thank you, folks.
Coming up, we are counting down to the closing bell on Wall Street and get you caught up on the day's top stories. We'll be right back.
Seconds away from the closing bell, let's break down the market action here in the final minute of trading. You're looking at the Dow right around the session highs of the day, up 395 points. S&P up just over 1%, as well as the Nasdaq. Certainly some gains across the board as traders begin to bet on the fact that a deal will be reached on the debt ceiling before that X date. We heard from President Biden earlier today, very optimistic comments from him, saying that he is confident that a deal will be reached. When you take into account some of the sector action that we are seeing this afternoon, consumer discretionary continuing to be an outperformer. We heard from a number of retail companies earlier today, Target beating on both the top and bottom lines, TJX also posting better than expected earnings. That, of course, really setting the tone for today's market action.
And there you have it, the closing bell on this Wednesday. As we see the market rally, we're talking about the Dow closing up more than 400 points, the S&P 500 up 48, and the Nasdaq up 157. Shauna, you nailed it right there. The debt ceiling, or at least the expectation that there will be some kind of deal reach here, really helping to push the market higher. And we saw that push bond yields higher as well, with the 10-year yield at 3.57. Consumer discretionary is certainly in focus, though, today with some of those retail earnings, pointing to a cautious note, but that didn't necessarily hit the stock in a big way.
It didn't. Kiko, let's take a look at Target, because that was one of the big movers of the day. Exactly like you were saying, the stock actually moving to the upside, up just about 2.5%, despite the fact that they were cautious about the current quarter. The retailer beat on the top and bottom lines, but like many others so far this earnings season, did warn that consumers are getting more cautious. Another standout number from this report, Target expecting to lose about $500 million from theft and organized crime this year. Obviously a challenge that the retailer has faced, as well as a number of names within that space in regards to the rise of theft and exactly the pressure that is putting on its profits. We can say that has been true over the last couple of quarters, but the fact that it is such an issue, it remains a big issue today. It's one of the many headwinds that Target is facing here at Kiko in the coming quarters.
Yeah, this is something pretty consistent, as you point out. We've heard from the retailer before. I'd be curious to see whether we can hear that. We'll hear that from Walmart when they report tomorrow. Interesting notes, though, from Target today in terms of where the consumer mindset is. The discretionary spending certainly slowing in a big way. They are still seeing some strength in things like beauty as well as groceries. Again, looking for some comparisons here with Walmart reporting next. Let's move on here to the regional banks. Stocks, they're surging today with PacWest, Western Alliance, and Zion all ending the day up over 10%. PacWest ended the day up more than 20%. The banks got some good news on Tuesday when Western Alliance reported that its deposits grew by more than $2 billion since its quarter ended. That eased worries about the health of U.S. regional lenders. This is one of those things, Shauna, that you get the sense that even though we saw a big rally today on some of those names, any bad news comes in and those jitters creep right back in. At least for today, though, we are seeing the sentiment turn a little more positive and potentially easing some of those concerns that we've seen percolate into the market over the last several weeks.
Yeah, that certainly is reflected in the share price action today. Western Alliance really trying to distance itself from the turmoil that has faced the regional bank sector here over the last several weeks. When it comes to what the street's saying on this, KBW's Chris McGrady, he was saying that this marks, quote, another positive update from Western Alliance, and the stock now starting to decouple from PacWest. And PacWest, we know, shares still off. They did rise about 20% today, but they're still off about 70% since the start of the year. So under a tremendous amount of pressure, Western Alliance is also still off just about 40%, but more and more on the street are starting to see, I guess, get a more optimistic view of some of these names. We know Bank of America resumed their coverage on Western Alliance this week with a buy rating, $42 price target, saying that their business model is, quote, more resilient than perceived. When it comes to the percentage of their deposits that are insured, Western Alliance is right around 79%, higher than it was at the end of the first quarter, which of course is something that investors want to see at Kiko.
Yeah, no question about that. Let's move on to another stock that we're watching today, another big mover, Royal Caribbean. The stock closing the day up more than 4%. UBS raising its price target on the cruise line, as well as its full year estimates, citing higher prices as well as demand. You can see other cruise stocks being boosted by Royal Caribbean's jump. This is one that we've talked about many times, Shauna. Certainly, I'm not the one taking the cruise here, but any sign of that demand keeping pace is certainly positive here when you think about just how significantly they were hit over the last several years.
Yeah, exactly. A lot of people are, maybe you and I aren't taking cruises yet, but a heck of a lot of people are, and that has really been reflected across the board. When you take a look at those booking numbers, we just heard from Royal Caribbean earlier this month. They were out with their quarterly results, and it was a pretty impressive report here, beating on both the top and bottom lines when it comes to future gains. This call here out from UBS saying that they actually see about a 30% upside from where the stock closed yesterday. So they are certainly betting that this momentum, the recovery that we have seen in the stock, that is just getting started. All right, the debt ceiling saga continuing after President Biden's meeting yesterday afternoon with House Speaker McCarthy and other high-ranking lawmakers. Things are looking up for a spending bill to go through. President Biden indicating in his speech today that one of the major sticking points, tougher work requirements for federal aid programs, could now be on the table. Let's take a listen.
I'm not going to accept any work requirements that's going to impact on medical health needs of people. I'm not going to accept any work requirements that go much beyond what is already. Well, I voted years ago for the work requirements that exist. But it's possible there could be a few others, but not anything of any consequence.
All right, Yahoo Finance senior columnist Rick Newman is here with us, who has been tracking every single update out of Washington. Rick, what do you make of what we just heard from President Biden, the fact that worker requirements seem to be on the table?
That was a very wobbly statement by him, wasn't it? So
He didn't want to
it
commit.
basically sounds like he's saying, I will accept some kind of new work requirements that are basically symbolic and hollow, but nothing that actually makes any kind of difference. That markets think that is kind of significant because it's one of the first times Biden is really putting something out there saying, okay, maybe he could make this type of concession. But you've also got a lot of Democrats, mostly progressives in the more liberal side of the Democratic Party, saying, what is Biden talking about here? Don't do that, man. Do not give in on this work requirement. So does this seem like something that could end up being part of a deal? Possibly. And I think everybody needs to remember here that the goal on neither side, among either political party, is to actually do very much that gets the national debt under control. It's to try to create the posturing that makes it look like you are serious about getting the national debt under control. So if Republicans would end up with a deal that says, see, we were able to enact some work requirements. Conservatives have been trying to do that for a long time. We won on this one. That's what they'd be after. And if Biden can say, we gave them a meaningless little sop to get them to prevent default on U.S. debt, no one's really going to hurt by this. That might be a win for Democrats, too. So we're not there yet. We're actually still pretty far away. But I guess we're happy to see even the smallest bit of progress at this point.
Yeah, so much of this is about the optics, because to your point, Rick, we did also hear from House Speaker Kevin McCarthy today saying in an interview that he doesn't think that the U.S. is going to default on its debt. So it looks like both sides certainly know the repercussions of getting past the X date. One thing I want to ask you, though, is this thing that we keep hearing the Democrats raise about urging the president to use the 14th Amendment to raise the debt ceiling. And I'm curious, as we get closer to that X date, where that conversation is. I mean, is that a real option that's being looked at?
It has to be a real option. I think it's a very low probability option because it's something that nobody has ever tried to do before, and it's not clear how markets would react. I mean, just to make it clear what everybody's talking about when they talk about the 14th Amendment, the 14th Amendment dates to, I believe it is 1868. It was enacted after the Civil War. And it's not mostly about debt, but there's one phrase in there that says the validity of the debt of the United States shall not be questioned. Now, nobody has ever exactly tested what that means, but the thinking among people who say invoke the 14th Amendment is that the Treasury Department should just continue to issue debt as if there were no federal borrowing limit. It would end up in court. It would get litigated. And I think one of the reasons this might be a terrible idea is you would really upset bond markets if the Treasury Department were now issuing debt that might not be legal, because there's this law called the federal borrowing limit that says Treasury is not allowed to do that. So in a way, you've got a law that dates back to 1917, and it was updated again, I think, in 1939. So you've got the 14th Amendment, 1868. It comes before the law. So if this ever made it to court, the thinking is, well, the Constitution comes first, and there's a good chance that the Supreme Court would say the debt ceiling doesn't even abide by the Constitution. Let's just throw it out completely. But it would be a holy mess before you ever got to that point. It's hard to believe that debt that was issued in this, what could be a long window period, where now the federal government is basically violating the law, that would be treated as ordinary debt. So very interesting idea, but a fairly risky one.
Yeah, it's an interesting conversation, Rick. I know we could count on you for a history lesson around the 14th Amendment. Rick Newman, as always.
I've had to learn all this stuff,
Keeping a very close watch on those discussions around the debt ceiling. Thanks so much for that. Well, coming up, we're going to break down everything you need to know from Tesla's shareholder meeting on the other side. We'll be right back. Well, Tesla is reversing course. CEO Elon Musk telling investors Tuesday the EV maker plans to start paying for ads to sell cars. That marks an about face for a company that's long resisted traditional marketing. It's one of many headlines coming out of Tesla's annual shareholder meeting in Austin. For more on what we learned from Tesla, let's bring in Kevin Paffrath, financial analyst and YouTuber. Meet Kevin. Kevin, good to talk to you today. It's interesting the way that Elon Musk kind of framed this, saying, look, I wasn't into advertising until I bought a company that was highly reliant on ads. But the fact that Tesla's now giving this a second look, does that point to some of the challenges they're seeing in the market as it gets more and more crowded and we start to see more price cuts?
Absolutely. And first of all, thank you so much for having me. Tesla is the largest position in my ETF. So when I was at the shareholder meeting yesterday, I'm like, come on, Elon, I'm trying to grab him by the shoulders and shake him. You can't just keep cutting prices, because if you cut prices of the vehicles, the reality is mainstream folks don't necessarily know about these new prices. And so you have to advertise. And this analogy that I made at the shareholder meeting was that if they drop the price of a vehicle $7,000, if instead they drop the price maybe $6,500, took $500 and threw it into advertising for every vehicle they produce, that'd be nearly half of Netflix's annual advertising budget of about $1 billion. If they just took $1,000 instead of doing price cuts and did ads, now they can talk about the features with the amount of money that Netflix spends on advertising. So simply put, they could spend billions of dollars in advertising with a very little portion of pricing remaining in the vehicles. And now we can talk about how Elon will take a 5-year-old car and provide it software updates to make the airbags safer, the restraint system safer, to make the braking system safer. These cars are becoming more valuable over time rather than less, like most cars, but nobody knows. Nobody knows the pricing of them, these updates, these features these cars get. And people think it's a luxury or very expensive vehicle when people don't realize you could buy a Model 3 right now for $36,000 after a tax credit and get all of these features. So taking a small bit of money in advertising would be a huge game changer for Tesla.
Kevin, what do you think about just the demand picture right now? I know obviously you're a big shareholder, but when it comes to some of the words that we got out from Musk yesterday saying that Tesla is not immune to the global environment right now, what do you think that then looks like, at least in the near term?
I think that was a good forecast from Elon that you should expect some rockiness in the stock over the next 6 to 12 months. Of course, if the Federal Reserve begins to slowly indicate, maybe come summer or September, that they're going to begin reducing rates, I think the stock market will slowly start pricing that in and rise even more. So I don't know that we're ready to make a new bottom, but I also don't know that we're ready to break any kind of new highs anytime soon. So Elon's probably right with his warning, wait the next 12 months. The beautiful thing, though, about Tesla is, in my opinion, now you have an extended opportunity to increase your exposure to it. And I think it's actually the best and most overlooked AI play that exists. Everybody's looking for AI stocks, and they're looking at companies like Google. And Google, by creating AI or integrating AI, is putting at risk 69% of all of their advertising revenue. So while they might gain some revenue in integrating AI, they're losing elsewhere. Where when you look at Tesla, the more they integrate AI, the more profitable they become. This is a company that could actually make a substantial amount of pure profit from artificial intelligence. Elon himself suggests that their margins could be zero on the car and 100% from artificial intelligence. We don't even have to consider robo-taxis or the Optimus robot in the future, just the full self-driving features itself with people sitting in the vehicle. Those margins could make this an extremely profitable company, more so than it already is. Yet now people are scrambling thinking, I'm going to invest in Microsoft or Google or Facebook because they mention AI. It's ludicrous. Tesla is the best AI play of the next decade, followed by the chip companies. The danger, of course, is the chip companies become commodities where Tesla maintains true pricing power.
Yeah, a lot of investors' ears just perk up there, right? We hear AI and they say, where can I invest in? You're saying Tesla is the big place to put your money. I'm curious to hear your take on the Cybertruck. Elon Musk has said, look, we want to start production by the end of the year. The numbers he put out, though, 250,000 to 500,000 units a year that he thinks Tesla can deliver on. It appears to be a little more of a conservative estimate. Is that realistic, you think?
It's probably still a little optimistic. So I know I sound like a real Tesla optimist, but I call myself more of a patient Tesla optimist in that I honestly think when they say they're going to have a Cybertruck delivery event this year, they are doing everything in their power to deliver one car by December 31st. So at least they can meet that promise. And I think the ramp for this vehicle is going to be very extended. That's because we're building the vehicle completely differently. We're building it from the outside in rather than the inside out. In other words, there isn't a traditional steel frame inside the car. The outside of the car is the frame. It's a totally different way of manufacturing. So I think a lot of patience should be kept in mind for the Cybertruck. And I really wouldn't start trying to model out the Cybertruck as being even that ambitious of a target, probably until 2025. I wouldn't be expecting a Roadster until 2030 or beyond. So I think patience will be very important for Tesla. But as an AI play, I think people who realize that AI potential and eventually these new products are going to be very well rewarded.
So Kevin, Musk naming a new CEO of Twitter, also saying that he's not going anywhere as the chief executive of Tesla. I have a feeling about what you might say to this, but how big of a win do you think that is for Tesla here at this point?
It's huge. Look, for the car company itself, it's probably not that big of a deal. Much like Tim Cook could step in for Steve Jobs, the roadmap had been set for the next 4 or 5 years, not to take any credit away from Tim Cook. I think he's great. I do think that Elon can walk away and let the auto division run. But what Elon's useful for is actually the next level, that AI, integrating the Optimus and getting to the next level of AI in full self-driving. That's where he is key. I think he can tie this vision together and guide the engineers in the right places to make sure we get what's practical and functional, in his words, quote unquote, for humanity. And so I think he is mission critical for that. For just the car company, he could walk away from that, and I think Tesla would be just fine. But hearing that he's saying absolute win, again, for the AI play. Now, they just need to advertise it. And I think they should hire Ryan Reynolds. His ads for Mint Mobile, that's the person we need pitching this. Deadpool, bring him in.
You want Ryan Reynolds to pitch Tesla? Is that your pitch here?
Absolutely. He is. I love Ryan Reynolds. I don't know anybody who doesn't love Ryan Reynolds. And I think the way he can convey information, well, not only that, but Elon wants valuable, information-rich ads. Ryan Reynolds can do that. Hey, it's Ryan Reynolds here. Did you know the lifetime ownership of a Tesla, the costs are lower than that of a Corolla? Holy, and then maybe some expletives with some bleeps, in his style and some comedy. It would do amazingly well.
I have a feeling you've already mapped all this out. Kevin Paffroth, good to talk to you today. Appreciate your time.
Thanks for having me.
All right, well, if you're hoping to snag a deal on a used car, it may be hard to find, according to a new report from Edmunds. Used car prices are softening, but they're still pretty high, historically speaking. Yahoo Finance senior autos reporter Praz Subramanian here to break it down. Praz, what exactly are we looking at here?
So used car prices in Q1 this year slipped a bit, 6.4%, but they're still up 44% compared to a year ago. So very, very high levels here from the pre-pandemic levels. So, conversely, the average transaction price for used cars is $28,000. That's compared to $19,600 5 years ago. So we're seeing that skyrocketing past that $20,000 mark, generally known as the mark as to where you could get a decent used car now. Now $20,000 used cars have 100,000 miles, things like that. So, why is this so bad? Many entry-level used car buyers are people that are buying their first car. And if they can't get a cheap, reliable used car, that can be bad for the economy and things like that. So, one thing that we're seeing that's a problem right now is supply too. It's not just prices, it's supply. Used car supply, especially those $20,000 sub cars, has now been cut in half. And Edmunds gives a bunch of reasons why. We're seeing low trade-in volume for people. People are hanging on to their cars. Low lease volume, fewer leases, so cars coming off leases is sort of depressed. And then finally, rental car companies are hanging on to used cars, or hanging on to their fleets longer because they can't replace them with cheaper new cars. So it's like a triple whammy here for why.
Yeah, so it also doesn't sound like the picture is going to improve anytime soon.
The only little possible good little bright spot is maybe if the new car market sort of weakens and manufacturers got to start incentivizing people to buy those new cars, they might bring downward pressure on the used car market, but they don't see that happening because the new car makers are more smart about their managing inventory. They're making fewer cars. They want to keep that price as high as possible.
Yeah, all right, interesting stuff. Praz, thanks so much. Well, coming up, we check in on a few stocks that you might want to keep your eye on, and a few you may want to avoid. We've got the names for you. They're up on the board. We'll be right back. Fears of a recession and looming debt default are spooking investors, and as uncertainty remains, those looking to put money to work are trying to figure out exactly what to buy and what they should avoid. So let's break it all down with Nancy Tangler, Laffer Tangler Investments CEO and Chief Investment Officer. Nancy, it's great to have you here. So you have some stocks for us to buy, some stocks that you're advising to hold to avoid at this point. Let's start with one of your buys. Starbucks. What do you like about it?
Yeah. So sometimes, and this is important for your viewers to know, you can get out of a stock for all the right reasons. And ours was there was no management succession. Howard Schultz coming back for the third time, labor problems, China, they doubled down on China. And we just felt like it was, something we'd owned for a very long time. So we got out and pretty much went straight up from there. And so we waited until Laxman, who's the new CEO, reported earnings and gave muted guidance. And so the stock sold off. And I just think he did that because that would be a smart thing to do as the new CEO, not raise guidance precipitously, just wait and then surprise to the upside. So they've got a lot of levers to pull. The labor thing seems to be okay. China's reopened, strong dividend growth. So we stepped back in and we'll continue to add on volatility.
And Nancy, Starbucks, one name that you like, but the other one that I thought was kind of interesting is your take on Disney here. Yeah. And I'm curious what this is, whether it's about the valuation of the stock or about the strategy, because we have seen a lot of restructuring happening since Bob Iger came back in.
Yeah, and I think the fact that he had to come back is a problem. I think there's a lack of shared vision in the company. He was behind the scenes, putting pressure on Chapek with the board, and I think that makes me worried about the future of the company. They are in three disparate businesses. One seems to be working at all times, but they're not getting credit for that. So great company, but not a great stock. And then the last thing I'll say is you're not even getting paid to wait because the dividend was suspended and there's no talk of even adding it back in. So we're on the sidelines.
When it comes to another name that you do like, though, Chipotle, and this kind of stuck out to me because we have already seen a massive surge in the stock, even just since the start of the year. Why do you think they're positioned well in this environment?
So one of our investing themes, Shauna, is old economy companies that are embracing the digital revolution. And Chipotle pivoted just the right way during COVID. They get $1 million in annual sales from each store on just digital orders alone. So it has a pretty, I'd say a full valuation. We were buying it during the pandemic, so our acquisition cost is about $500. But it's a growth stock that's always had a lofty valuation. They've got pricing power and excellent management.
And Nancy, you mentioned pricing power. I am curious about that one because the digital strategy and their success has long been documented. They've also been pretty out ahead in terms of those price hikes, and they've sort of been able to play both sides. Consumers still coming along. They are still coming through the stores, even at a higher price point.
Yep.
What is it you think about Chipotle that has allowed them to do that? And is that kind of a strategy that you're likely to see, or a strategy that you think other companies have been able to find success in?
Yeah, I think it's brand. I think that's really what it comes down to. I mean, the food is good, of course. They're adding Chipotle lanes, which makes it more convenient. But it all comes back down to brand. And you could make the same argument about Starbucks. How much are you going to pay? How much are you going to be willing to pay for that iced latte? I mean, mine the other day was $7.25, and I bought it. So I think that's some of it. Now, that doesn't mean growth isn't going to slow if the consumer gets softer, but eating out and at that price point, I mean, I'd actually rather pay that much for a burrito than I would for a cup of coffee. So I think they just have a lot of the right elements, and it's clean food people perceive, and it's good.
Nancy, speaking of pricing, a little bit different though. We have certainly seen the pricing, a number of pricing variations when it comes to Tesla. I know one of the plays that you have liked recently. We just heard from Elon Musk yesterday at the annual shareholder meeting. What do you think about how Tesla is positioned now? Because he did warn that the next several months could be a bit challenging here for the company.
So Tesla and Elon right now remind me of Apple when Tim Cook took over. So there was a transition going on in the company. People were underestimating him for sure, Tim Cook that is, and they were worried that it was just a handset company. But it was really about services. And we started buying the stock in 2012 because we liked the services ecosystem story. I think Tesla has the same thing going on and people are overlooking that. I mean, for example, they have a $300 million insurance premium business that no one talks about. So the ecosystem, they're cutting pricing to draw people into the ecosystem, and that has sustainable earnings growth power in the future. I also think it's kind of interesting that people are bemoaning the decline in their margins. It's still 4 times or 5 times Ford's, and they forced Ford to cut EV prices twice this year. So I think him sort of experimenting with advertising, I don't think that's a sign of weakness. I just think it's smart business.
So interesting, Nancy. I mean, it sounds like you think there's a whole nother lever here to be unlocked when it comes to Tesla. How big of a concern is that distraction part of the conversation? I mean, we know that Twitter now has a new CEO, but Elon Musk has made it pretty clear, I'm still going to try to run both sides.
Yeah. And I'm going to say whatever I want. So we actually picked up the stock in January. We'd owned it years ago, kind of underestimated him when he was going through all the problems with management, didn't have an independent board of directors. And remember, he was on the Joe Rogan show. I don't need to finish that sentence. So we felt like at that point, it was kind of gambling for our clients because there was no management succession. Now he's got one of the best CFOs in the country, I think. And he has hired, like as everyone requested, he has hired woman to take over the company, Twitter that is. And so for us, it just feels like he's marching at his own pace as he always does. But I don't think the distraction factor is the same with him as it might be with other CEOs. And so we were beneficiaries of people selling the stock and he selling the stock at the end of last year because we picked it up in early January in the low 100s. So we're pretty happy with our investment so far.
Yeah, and you should be given the returns that we've seen since the start of the year. Nancy Tangler, great to have you. Thanks so much. All right, well, coming up, networks and streaming giants unveiling their new shows to advertisers this week. We'll break down what you need to know on the other side.
And a great hostess, iconic Twinkie. And that'd be a great experience.
Well, Netflix is about to hold its first ever upfront presentation. The streamer is now in the position of having to bring in advertisers for its ad-supported tier. Joining us now is Jessica Tunkel, Deputy Media Editor at the Wall Street Journal. Jessica, it's good to talk to you today. You, as in the Journal, has a story out today talking about some frustrations that may be percolating here when it comes to being able to sell ads on Netflix's platform. What are you hearing about what that demand picture is looking like?
So I think advertisers were very excited when Netflix announced they were going to be launching an ad tier. This is like a dream for many advertisers to get their brands in front of very premier content as Netflix and its huge reach of hundreds of millions of people. Netflix has started off slow. They have a smaller number of ad-supported subscribers right now to the ad tier. We reported today, according to data from Antenna, it looks like it's around 800,000, a little bit more as of March. And the challenge for advertisers is they want to be able to target their customers. You can only do so much targeting and personalization to customers and to get the customers that you want if the base is that small, and you only get so much inventory. So they want it to be bigger, they want more reach, they want Netflix to be marketing this ad tier more, and they just haven't seen it yet. So it's frustrating, but it's very early days. So, it'll be interesting to see what Netflix talks about at their upfront today.
Jessica, what do you expect Netflix to focus on here? Because there has certainly been a lot of concern just about the slowing growth in that space, what exactly that means for the business, how much of that can be solved by their ad tier side of it. So what do you think will be that big focus when it comes to their new content?
Look, I think Netflix will be very clear that they are still the 800-pound gorilla in the space. They are the biggest. They are profitable. They are where the advertisers want to be. They have the most content. So I don't think that they're going to shy away from that. I will say that I also think that they're saying we're starting slow. We're being careful. We're going to be bigger. As they've said before, they're going to start. I don't know if they'll talk about this at the upfront, but I imagine they'll talk about how they're going to, they're rolling out this crackdown on password sharing. And as part of that, they're saying to people, like if you have a college kid that's using the parents' login, they'll say, hey, why don't you pay $6.99 for this cheaper service with ads instead of, because we're not going to let you just freeload off your parents anymore. So that will increase the volume. And I think the plan is to increase the volume, and you'll see more subscribers joining the ad tier as they roll out the password sharing crackdown.
Netflix, of course, not the only one with the upfronts here, but there is a big cloud hanging over all of them, which is the writer's strike and the impact that's likely to have. So far, we have seen these studios put their best face forward, saying they've got the pipeline, they've got the content to withstand some of the challenges, at least for now. What are you hearing behind the scenes of what this could look like the longer the strike drags out?
I think that when I was just talking to some studio executives an hour ago, I think that they are feeling very confident about how long if this lasts a long time through the summer, what position they will be in. I think for some of these companies, they're looking for a reason to cut costs. And if that means, frankly, cutting the contracts with some showrunners, so be it. Like, none of these streaming services outside of Netflix are profitable right now. So they are all looking to cut costs. And the writer's strike is kind of, from that perspective, has come at an opportune time. If this keeps going into the fall, you're going to see some issues, obviously, particularly with networks, broadcast networks that usually debut shows in the fall.
Jessica, when it comes to some of the streamers, when they're trying to get a competitive edge against some of the others out there, we have seen more and more turn to sports. And I know you reported earlier this week on the deal that the NFL had reached with Peacock for one NFL playoff game. What do you think this really just signals about the priority that these streamers are placing on sports and how important that is to the future of streaming?
It's so interesting because sports was, like, not even that long ago, the one thing that the TV networks were saying, this is ours. The streamers won't get this. This will be ours and we'll own the rights to it. And this is one of the only reasons that people would actually today are still turning on live cable TV is to watch sporting events. However, now you're seeing the streamers really kind of pick at that. So you have the Peacock got the wild card game. You have, YouTube TV. YouTube just won the Sunday Ticket, which was a big surprise to many people. The NBA rights are going to be coming up in several months, and a lot of people are wondering if the streamer is going to get that. So it's becoming a real battleground between the streamers, tech companies, and the traditional entertainment companies.
Yeah, and you have to wonder how much longer Netflix is going to remain an outlier, at least when it comes to sports. Jessica Tunkel, the Wall Street Journal's deputy media editor, good to talk to you today.
Thanks so much.
Shares of Hostess Brands are closing the day just to the upside, just above $25 a share. CEO Andy Callahan joined Yahoo Finance earlier today to discuss the company's most recent earnings report and the future of the snacking industry. Let's take a listen.
Consumers have been increasing their snacks and engagement with food for years. The average consumer, nearly 50% of consumers snack 3 times a day. And that's an indulgent snack, is increasing at a greater rate than health and wellness or functional snacks. So this is a macro trend that accelerated in the pandemic, and consumers are looking for more contemporary, indulgent snacks that fit their lifestyle. So we have iconic brands, but we're complementing that with new forms. Casbar is a perfect example, but that's been happening for years, and we're there innovating to capture that trend.
Andy, Brian here. Good to see you as always. Of course, you know me, did some extensive research on Hostess by eating a lot of your newer snacks ahead of this segment. And something seems different. They seem more on the go focused. The packaging seems a little different. Who are you focused on with these snackable type new products? And then where else do you have room to play, I guess, in the reinvention of one's lunchbox?
Yeah, at a macro level, we have 2 really terrific brands and businesses. Our Wortman is the leading reduced sugar brand in cookies. Our Hostess brand, obviously our iconic brand, which is nearly 90% of our portfolio, really focuses on indulgent snacks. And you're absolutely right, Brian. We focus on millennial parents and C-store males are 2 really important consumers to us, where we're increasing the percentage of their usage. We're also increasing the amount of times they come back and buy us multiple times. And the way they snack is different. They're looking for not compromising on the indulgence. They want it in smaller bites and convenience. And some of the products you're talking about, whether it's Casbars that we just launched or Bouncers, they fit that bill. They're very convenient. They're very shareable for the millennial parents, and they're more indulgent and potentially larger for a C-store male. We're really focused on them, and our strategy appears to be working.
Does that also, it's Julie here, hi. Are they also higher margin for you guys because they happen to be smaller or just configured differently?
Yeah, well, we enjoy some of the leading gross margins in food, where our gross margins better most, our EBITDA margins actually near the top. And when we innovate, we're focused on that. We never compromise quality. We try to bring consumers the best value. And our philosophy is that over time, all of our innovation is going to be at fleet gross margins or better as we grow. And we're doing a nice job doing that. Our single serve business is growing extremely well. Our Wortman business, which is higher margin than our total average, is actually growing at a greater rate. So margins is very important to us, and protecting them is very important to our sustainability.
Andy, I don't know if you saw Target's earnings this morning, but I think they really scared a lot of folks out there with this call out of retail crime. Now, you sell into a lot of these big box stores. I mean, are you seeing customers or these types of crowds come into big box stores and take your goods off the shelves? How do you think about it?
Yeah, we don't experience that as much. We're a very accessible, reasonably priced snacks. I can't claim to be an expert at that. One of the strengths of our business is the breadth of our availability to consumers. We're nearly ubiquitous. We're 10 points higher in distribution than the next nearest sweet baked goods. But our partnerships with our customers are extremely important. So the integrity of our supply chain, our service to our customers, we service them, we work with consumers and share that data and try to partner with them on category growth. Our strategies to grow the category and bring more consumers into snacking is aligned with what our customers want to do. So we have relatively short shelf life. We invest in quality, and we're baked goods, so we have relatively short shelf life. So we don't see that issue, but we empathize with our customer and always working to try to solve their problems.
In the future of snacks, how does quality improve? Because I'll be quite frank. I've been extremely critical of a lot of snack problems or a lot of snack products that are currently out on the market, whether it be for the sugar level or whether it just be for whether or not they stay apart or stay together when they're in my hand. How are we improving on the quality of snacks?
You know, quality is probably, after taking care of our team and keeping them safe, quality is our next priority. And being able to bring snack baked goods to ubiquity at scale is not an easy thing to do, and bring that a quality that consumers want is a hard task. We like it that way because we believe, and I believe in our great team does it better than anybody. And we have a really terrific opportunity to bring baked goods combined with the indulgent snacks consumers want in a way that hasn't been done before and at a scale that hasn't been done before. The snacking category is $65 billion. We're a really small part of it, but consumers' ubiquity of love of baked goods is universal. Their love of snacks is universal. And we're trying to bring them in contemporary ways, and we try to do it in a quality way. I said before, I encourage anybody who hasn't had a Twinkie in a while or hasn't tried one of our new snacks in a while, they try them. They're always surprised at the quality of our baked goods. So we invest in that a lot. It's important to us if consumers, regardless of how much discretionary money they have, if they're coming to intersect with our product and they want that joyful indulgence, we want it to be the highest quality experience they can get.
There's been a prioritization of health and wellness coming out of the pandemic as there's this renewed focus on just taking care of yourself. And for that's why snacking has been taking out a lot of people's diets. So how does Hostess look as a brand in an era where people are tracking the Fitfluencers online, they're tracking their own regimens, they're tracking their caloric intake, and if you're like Sazi, you're tracking your macros with every order that you make?
No comment.
What does that look like in that future?
Well, let's get the facts straight. The future is that consumers in a macro level are engaging in snacks more. And they're engaging in indulgent snacks more, but the way they do it is different. The idea that if you eat healthy, you don't enjoy an indulgent snack is a false narrative. Consumers have more snacking occasions, and if they indulge in a sweet snack, they want it to be good. They want it to be portion controlled. They want it to be good. So that's a macro trend that consumers are staying forever, and it can be a small part of a good, balanced, healthy diet. That's the macro trend. This idea of moving from one end of the pendulum to the other, that's not the way young millennial parents and young millennial males think about it. They think about their life, and Dan O'Leary, a great growth officer, articulated that at a recent conference, that's a false choice. The macro trend is consumers snack and eat in balance. And that's what we're trying to be there for. And we want it to be as responsible and indulgent as possible. But the same consumer can eat overall healthy and then try to reward themselves once, twice a week with a great indulgent snacks. And when they do it, I want it to be a great Hostess Casbar, a great Hostess Bouncer, and a great Hostess iconic Twinkie. And that'd be a great experience for them. And that's what we're focused on.
Our thanks to Hostess CEO Andy Callahan and Yahoo Finance's Brad Smith and Brian Sazi, as well as Julie Hyman in there. All right, Kraft Heinz is changing the way consumers can get their dipping sauce. It's calling the new sauce dispenser the Heinz Remix. Brooke DePalma is here with the details all over that story. Brooke, what can we expect?
All over that story, certainly, and you're not alone. The hype around this seems to be pretty real as consumers just are going out and about more post-pandemic, and this ultimately took the team 6 months to build. Now, we got to see a rendering of it. It's about 2.5 feet wide, 2.5 feet deep, and features a large touchscreen. The first iteration that they're calling this, as you noted, the Heinz Remix, customers can choose from 4 different bases, including Heinz ketchup, ranch, 57 sauce, and barbecue sauce. It also includes what they're calling enhancers. So you could choose from low to high intensity of jalapeno, smoky chipotle, buffalo, and mango, really getting at the personalization that customers are craving lately. But when exactly we'll see it? Well, it might just be a while. They're set to debut next week at the National Restaurant Association show in Chicago, and then it'll debut in sort of restaurants in late 2023 and early 2024. I asked Peter Hall, Kraft Heinz executive, what exactly sort of restaurants we'll see it at, and he said, well, the options here are limitless. He said we can expect to see it at things like movie theaters, ballparks, football stadiums, schools, college campuses, theme parks, and when even said Army basis. Now, two goals here that Kraft Heinz looking to hit is increasing efficiency. From the moment that the customer chooses what they want, it takes the machine about 8 to 10 seconds to ultimately fill up their cup and leave the machine, and also increase efficiency for those restaurant employees. They said that they only have to replace the bags once a day here. And in addition to that, this will also give Kraft Heinz an option to get deeper consumer insights. There's over 200 combinations that customers can choose from here. And so Kraft Heinz eventually will take those combinations and potentially bring them to market. It'll also take those combinations and give them to the restaurant operator. And that's building that back end in a partnership with Microsoft. And this is all part of Kraft Heinz' larger plan to increase total sales in North America by $200 billion incrementally by 2027. So lots of hype here and lots of excitement, certainly.
Smoky Chipotle and mango. Those are the two I want to try there. Let's talk about another headline that we got today. Wendy's trying out underground deliveries through robots. What's that all about?
Well, Akiko, don't think that they're delivering it straight underground to your house. You have to be at the pilot location in order to get this here. But Wendy's, that's right, they're teaming up with a company called Pipedream. They're a hyper logistics company. Now, this autonomous robot system will ultimately go from the kitchen to a parking spot. They're calling those parking spots Carside Instant Pickup portals, and they says that the food will be delivered within seconds. Now, this comes as Wendy's double downs on that commitment to hot and fresh, particularly when it comes to delivery. We saw them introduce hot and fresh fries. In addition to that, digital sales, they're trying to make a boost there. They made up about 11% of its sales mix in the U.S. last quarter, but no word yet on where exactly we can expect this pilot to take place. But what we do know is that we could see it as soon as later on this year.
Yeah, it's been interesting to see the increasing use of robots in the delivery space. Brooke DePalma, as always, on the food beat for us. Thanks so much for that. Well, coming up, we're going to check in on a few tickers moving after hours. We'll be right back.
Let's take a look at a couple of trending tickers after hours. We have Take-Two for you and Cisco, two stocks that are on the move. First up, Take-Two shares up just about 7%. The company reporting better than expected numbers in the fourth quarter, beating on bookings. That was up 64%. on a year-over-year basis. In terms of the guidance, though, that coming in just a bit light, saying that they do expect a bit of a slowdown here in fiscal year 2024. The company saying in the release, quote, the forecast reflects a challenging consumer backdrop. Also the fact that the extension of development timeline for some of its high-profile titles that has been pushed out, but it looks like the street is really focusing on the better than expected numbers that we just got for the most recent quarter. Bookings, again, up over 60% on a year-over-year basis. You're looking at gains of about 7% in extended trading. Flipping over to Cisco, a bit of a report here to unpack. You're looking at the shares off just about 4%, despite the fact that the numbers were pretty strong and they actually lifted their full year guidance. They raised their full year profit guidance as well as their revenue outlook. They now expect sales for the year to come between 10 and 10.5% growth compared to the prior year. The headline numbers were strong, but some weakness in those underlying numbers here. For example, service sales, that was up just 3%, so slowing growth there. That, of course, is a bit of a worrisome sign here for the street. We're looking at shares off just about 4%. Akiko?
Well, it is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. The Dow closing more than 400 points higher today, thanks in part to increased optimism on the debt ceiling. President Biden and House Speaker Kevin McCarthy both indicating that there is some progress being made on a deal that would keep the U.S. from defaulting on its debt.
One of the top trending stocks today was Target. The retailer's first quarter results topped analyst estimates, but there are signs that consumers are starting to be more cautious with spending. Target leadership also highlighted its struggles with theft, estimating that it's going to lose $500 million in profit this year, mostly due to organized retail crimes.
And finally, a judge says disgraced Theranos founder Elizabeth Holmes must report to prison by May 30th. This coming after losing her bid to stay out on bail while she appeals her case. Holmes, of course, was sentenced to more than 11 years in prison after being convicted on 4 counts of financial fraud.
All right, well, that'll do it for us today on Yahoo Finance Live. We'll see you right back here again tomorrow afternoon. Have a good night.